For this reading, we get to look at security market indices. So in other words, when you're listening to a news report and you hear that the market was up or the market was down, or the S&P, maybe to be more specific, was up or down, well, all that comes out of an index that tracks activity in the market overall or some segment of the market. And as it turns out, there's just lots of ways to put these together, and the way you put them together actually will have a fairly significant impact on what the index tells us at the end of the day or the end of the year. So let's spend a little time talking about where these come from and then how we put them together. And at the very end of this reading, we'll spend just a couple of minutes looking at some of the more broadly followed indices that are out there. And I don't think it's something you need to memorize, but it'll give you some flavor for the variety that's available. So a security market index, this is going to represent the value of some set of assets. Okay, we can think again maybe the Standard & Poor's index as being one of the most broadly cited, or maybe the Dow. So it represents the value and then over time performance of an asset class, an entire market or market segment. So index value is going to be calculated from market prices of the index's constituent securities. So if you're talking about the S&P 500, well, that's going to be the 500 securities roughly that S&P puts into that index. So there's going to be various weighting schemes. So how is it that we're going to measure return through time? And the weighting scheme that we choose is going to impact what we end up concluding in terms of performance for that particular market or segment or whatever it is we're measuring. So a couple of ways to start. We could think in price return versus total return. So you'll recognize this equation, I'm hoping, as just a simple holding period return on an asset that doesn't generate any cash flows. So ending price, that's just P1 divided by beginning price P0 minus 1. All over the curriculum, so you want to make sure and be able to calculate a holding period return. So that's just the change in the value of the assets. If you're talking about something like a stock index, right, well then you can see changes in the value of the assets, but there's also going to be cash flows, right? So there'll be dividends, or if it's a bond index, there would be interest payments. So you have to decide, do you want a price return or do you want a total return? Well, a total return is going to be something that includes any cash flows that the constituent securities would have paid during the period that we're examining, right? So total return is just price return augmented by whatever the cash flows are for the underlying securities. If you decide you want to put your own index together, okay, there's a bunch of decisions that you have to make. First, you have to decide what market, okay, does the index represent. So is this going to be, large cap stocks? Is it going to be junk bonds? Is it going to be, overall equity investments? Is it going to be U.S.? Is it going to be U.K.? Is it going to be worldwide? All those types of things. Once you decide what market you want represented, then you're going to have to decide which securities to include. So the Dow includes 30. The S&P includes roughly 500. The Wilshire 5,000. So you're going to have to make a decision about which securities to put in there. Then you're going to have to decide on a weighting scheme. That's what we're going to talk about next, the different weighting schemes. And depending on the weighting scheme you choose, you're also going to have to decide how often am I going to rebalance this portfolio. So for instance, if we were doing something that was equally weighted, well, I have this set of securities. I put all equal weights on each of them, but as one has a higher return than the other, then you're going to get more of that security in the index. And then you're going to have to go back and say, well, when do I level things out again? So rebalancing is going to be important. And then also you're going to have to say, well, the world is a dynamic place. Okay? So if I choose 100 securities to put in there today, that probably won't be the same for all of eternity. So how often am I going to re-examine which securities should be in my index? All right. Let's talk about these price weighting, or the weighting schemes. So the first one is to weight by price. So a price weighted index. And that just says that the value of the index at any point in time is going to be the sum of the prices of the underlying securities. And then I'm going to divide by the number of securities in the index. And this does get much more complex if you do the adjustment for splits and all those types of things, which we're not worried about in the curriculum. So we're going to conform to the KISS principle, keep it simple, stupid. So we're not going to worry about split adjustments here. But all we're going to do is say, look, take the price of each stock in the underlying index, add it up and divide by the number. So the way you would replicate this index is you would match the index by buying an equal number of shares of each of the stocks in the index. So you could buy, 1 share of each of the stock or 1,000 shares of each of the stocks, but you would buy, the same number for each of the constituent assets. So it's going to have all the weighting schemes are going to potentially have a bias. So the bias here is going to be that if you're looking at stocks, some of them have prices of $10, some of them have prices of $100. Well, if there's a 10% change, so a given percentage change, then a high price stock goes from 100 to 110. Okay, well, the low price $10 stock goes from 10 to 11. Well, that $10 change in the numerator is going to have more impact than a $1 change in the numerator. So this particular weighting scheme is going to make it so that high-priced stocks have more influence on the index. So high-priced stocks are going to have more influence. An example of the price-weighted index would be, the Dow Jones Industrial Average, or the Nikkei Dow for Japanese markets, but nonetheless, same thing. So anyway, this is going to be a price-weighted index, and it's going to be biased toward the performance of high-priced stocks. So let's talk about market cap-weighted index. So market cap, this is in some sense the truest form of indexing because it's going to have each security represented in proportion to how much value they have in the index overall. So this is unique in that, at least in a simple world, you would never have to rebalance a market capitalization weighted index. As one stock goes up in value, another goes down. Well, one stock becomes more important, but it also has greater weight in the index. So because you're market cap weighted, it's already changing itself. It rebalances itself through time. So a market capitalization weighted would just simply say we're going to take the price today of a single share and multiply it by the number of shares, and we're going to do that for each stock in the index and add them all up. Okay, and then we're going to divide that by the same calculation from the base year, and we'll multiply that by some beginning index value. This is usually a numeraire like 100 or 1,000 or something. So anyway, we're going to just take the market cap of all the stocks today, price times shares, divided by the base, and that's going to be the calculation. So if you want to match this portfolio's weights, you're going to buy each stock in percent as a percent of the market value that stock would represent in the index overall. So if you're thinking of the S&P, which is a market cap weighted index, then there's certainly 50 stocks at the top that make up a huge portion of the overall market capitalization. So if you think Microsoft is there. Microsoft represents a really large portion. They're much more than 1/500th of the index. So you would put more money into Microsoft and less money into McDonald's. So what's going to have influence here? Well, if you think of a 10% change in the value of a company, well, if you have a really large company like Microsoft, 10% there is a lot. Smaller company is going to have a smaller influence. So this is going to have the larger the market cap, the larger the influence is going to be on the index. So firms with larger market cap influence the index more than firms that would be smaller, right? So just because for a given percentage change in the overall capitalization of the company. Now, this is sometimes viewed as, frequently viewed as having a momentum tilt. So that means that we're tilting toward growth companies, and we can call these overpriced stocks, and you have to be a little bit careful in thinking about that. But remember, there's uncertainty about the value of each one of these 500 stocks. So even if we had a really efficient market and analysts that really knew what they were doing, then on average these may be valued correctly, but there's going to be some that have higher values and some that have lower values just because of the vagaries of life, right? Well, if you have those that have run up above their fundamental values, okay, and even though we aren't able to recognize that, we know it happens in a big index in a portfolio. So those that have had their price run up above their fundamental value, those are the overpriced stocks. Well, that also means their market capitalization is going to be higher. Okay, so we're going to be tilting towards those overpriced stocks, and that's going to give us something of a momentum tilt, meaning that as stocks run up, they become more important in the index. Right? We can also do a market float weighted index. That's where the number of shares are going to be equal to the investable shares. So if you have, Facebook and you've got Mark Zuckerberg, who still owns a big share of them and is probably going to own them for the next 30 years. Okay, well, those would not be investable on a regular basis, so maybe we want to exclude those. So we're going to look at market cap or market float weighted. So we won't use the total number of shares outstanding. We'll just use those that we think are reasonably likely to enter the trading realm. We could also do free float, and this is where we would exclude shares that weren't available to foreign investors. So some shares only be owned by Malaysian citizens for this Malaysian company. Those types of things, we would exclude that when we were calculating the index weights. So a fundamental indexing or a fundamental index weights, we've talked about weighting on market cap. We've talked about weighting by price. We're going to talk about equal weighting in a moment. But we could weight by anything, right? So we could say, well, let's look at the total amount of dividends. And, if you contributed 5% of the dividends, that's going to be 5% of your weight in the index. So that would be weighting by some fundamental attribute. Okay? So the proportion of the index or the weights are going to be based on a proportion of the total value of a fundamental factor. So we can weight based on revenues, right, or earnings, or book value, or cash flow. So take the total cash flows for all of the companies. We're going to say, well, what portion of the total cash flow did you account for? Well, that's going to be your weight in this particular index. And it tends to lead to a value tilt because we weight on things like book to market. So if book to market gets high, then we're going to, the book value gets high relative to the market value. Well, then we're going to see that those are companies that have been beat up if book is high relative to market, and that gives us a tilt towards the value end of the investing spectrum. So fundamental index weights would be these things that frequently have a value tilt. So GDP weights, if we're doing multi-market, means, well, we're going to have 23 companies or countries in the index, and how do we weight those different countries? Maybe we weight them by GDP. So we say, let's total up the GDP for all of them. If the United States happens to be 17% of the index, then 17% of the index would be weighted towards U.S. securities or something along those lines. Okay, an equal weighted index, okay, this just says, well, not a price weighted index, but instead we're not going to distinguish between the size of the companies or the price of the companies or anything else. We're going to allocate an equal weight to each of the securities. So the way you would match this is you'd say, look, there's 10 securities in the index. I'm going to put $10 in each of them, right? So you're going to have an equal investment, equal dollar amount investment in each of the index securities. And then the return is simply going to be the average holding period return for the index stocks. The trouble with this, of course, is this is the one that leads to the most rebalancing problems, I think. And that's because as you say, okay, I invested $10 in each of them. One goes down to $8, the other goes up to $20. Well, now we've got a lot different size investments in this when we said we were doing an equal weighted index. So we're going to have to be rebalancing this frequently. Very frequently, an equally weighted index, in particular in equity securities, is going to get rebalanced on a quarterly basis. Okay, so what about comparing the weighting schemes? Okay, it's very important that you understand this first sentence up here, right? And that is that we're comparing this to a market cap weighted index. So all of these things that we're going to conclude as we go down this list, this is going to be relative to something like the S&P, a market cap weighted index. So a price weighted index is going to put more weight on high price stocks. Okay, and then things like stock splits are really going to change all the weights, right? So, and who is it that's splitting their stock? Well, it's growth companies that split their stock, right? It runs up to 300 and they split it, 3 for 1, so the price goes way down. So this ends up being weighted away from growth stocks because the growth stocks make themselves less important by splitting their stock. Okay, an equal weighted index, this is going to place more weight on small cap companies. So if you think, okay, I'm looking relative to a market cap weighted, then Microsoft gets lots of weight, McDonald's gets less weight. Okay, well, we're equalizing the weights in an equal weighted index relative to a market cap. Float adjustment or float adjusted index is more closely going to match the investable portion of the shares outstanding rather than looking at total market capitalization. This is going to be particularly true if you get outside of the U.S. So anyway, so a float adjusted is going to say rather than number of shares issued and outstanding from the financial statements times price per share, it's going to bias it towards not bias it, it's going to base it on the number of shares that we think are actually tradable or floating. And then a fundamental weighted index relative to a market cap is usually going to have a value tilt. It's going to be tilted to those stocks that have been beaten up. Okay, a couple of examples here. So if we're going to calculate a price-weighted index, so we have 3 stocks here. We know the share price, we know the number of shares outstanding, the market cap, okay, and we know that on November 30th and December 31. Well, if we're doing a price-weighted index on November 30th, we're going to take our 3 stocks and we're going to add it up and we're going to get $90, right? So the average price of a stock in the index is going to be $30, 90 divided by 3, okay? And then a month later, we're going to look again and we're going to say, okay, what's the average price now? It turns out to be $93. So the average price was 30 and it goes to 31. So what's happened to the index? Well, we're going to see that there's been a 3.33% increase in the value of the shares based on the change in the price of the shares of stock that are included in the index, right? So in this case, we're going to say, all right, we've had a 3.33% gain this month based on this price-weighted index. Now, given the same data, let's look at it and do a market cap weighted index. So if we take the number of shares or the price per share times the number of shares outstanding, then we get market cap over in this column. So the market capitalization for our 3 constituent securities in aggregate is $16,000 on November 30th. It goes to $16,400 by the end of the next month, December 31st. So what's that mean? Well, this has been the change in the index, right? So this is P1 over P0. Okay, and then so that is effectively 1 plus the holding period return, right? So holding period return would be P1 over P0 minus 1. Since we're not subtracting out the 1, then that just P1 over P0 is 1 plus the holding period return. And then we multiply that by the beginning value of the index. Okay, so in this case, we made an assumption that the index started on November 30th. We assigned it a value of 100. So we're going to take 16.4 over 16, multiply it by the beginning value or value from the last period, and what we get is 1025, and that tells me that I went from 100 to 1025. So I've got a 2.5% increase in the value of the index. And you can see that, of course, this is just a little example we put together, but price weighted, we had 3.33% return, here a 2.5% return. Well, based on how we weight these things, we're going to see significant differences. Finally, an equally weighted index, okay, we're going to have an initial price for the stock and a current price, so for whatever period that's covering. We're going to assume that the initial values were determined when the index value was equal to 100, so we're starting the index there, I guess. Stocks X, Y, and Z, the first one went from 30 down to 27, so we lost 10%. The other 2 show gains, 50% and 10%. We're just going to take the average holding period return. So that's going to be P1 over P0 minus 1. Okay? And then we're going to add them all up, divide by 3. So the value, so the average has been 16.67%. So the index value at the end of the period is going to be the index value, the initial index value times 1.1667 to reflect the 16.67% increase. So it'll be 116.67 as the index value. All right, so an equal weighted index here at the end. All right, so those are the 3 major themes, price weighted, market cap weighted, equal weighted. So you want to make sure you're on top of those. Some of the subtleties associated with float and the bias and the tilt, that sort of stuff, things that are really easy to write questions about. Okay, rebalancing and reconstitution. So rebalancing, we're going to update the index weights on a periodic basis. That's not usually required for a market capitalization weighted index, it's going to be demand frequent attention if you're doing a equally weighted index. Reconstitution, this is where we, adding or deleting securities from our basket. So that's going to happen, on a fairly regular basis. So, S&P will announce, and I don't even know what the formal guidelines are, but it seems like every year they drop somebody and add somebody, that type of thing. And so that's going to be when they reconstitute the securities that are in this basket that defines the index. The uses of index, of course, it's going to reflect market sentiment. So if you think market sentiment was dark in 2008. The indices were way down. We can also use it as a performance benchmark. So if the index is up 12%, well, how did you do? Okay, well, if the index is up 12 and you're only up 9, well, you didn't do very well relative to that benchmark, right? So we can think of that as a bogey portfolio. We want to measure market return. So, well, how the market's done is that's a measure of the overall economic climate as well as the political situation. So measuring market return would be another reason. Calculating beta. So you've talked about beta in terms of the capital asset pricing model. But calculation of beta is going to be how the value of a particular security changes relative to the overall market. And for the market, we're going to have to use an index. So to calculate beta, we would need some sort of market index. We can calculate expected returns and adjusted returns. So that goes along with the idea of beta, right? So beta is going to give us a way to calculate risk-adjusted or expected returns given an amount of risk. And so if we want to know if we're beating our risk-adjusted benchmark, well, this would be one use for it. And then finally, we can use this as a model portfolio. So I'm a big index investor, so I invest in funds that mimic, well, I like the ones that mimic the Wilshire, but I usually end up in those that mimic the S&P just because those are usually cheaper. So that would be the S&P as a model for the index funds that are managed by Vanguard or Fidelity or whoever it happens to be. Okay, types of equity indices. So we can have broad market index. That's going to, various weighting schemes on that, but we're trying to capture the broad market. Okay, we can have multi-market, market cap weighted, so that'd be looking across countries. Multi-market with fundamental weightings, so looking at countries, different countries, and instead of using the market capitalization, converting everything into a single currency, adding it all up, well, what portion of this global index does Nokia constitute? Instead, we could just say, well, let's look at the indices for each of the countries and then weight by GDP. So GDP would be a fundamental indexing for a multi-market scenario. We can also have sector indices, so healthcare, technology, finance, all those types of things. So transportation, you can see what's happening in the different sectors in the economy. And of course, style, so large cap, medium cap, small cap, and then the favorite discussion of mine anyway is value versus growth. So you can think of style portfolios as well. So all of these are things that we could try to capture and gain insight into via indices, and then all this specifically refers to equity. We can also measure the return on fixed income securities. So we can look at those by maturity, long, medium, short. Okay, we can do it by the type of issuer, investment grade, non-investment grade, sovereign. We can do it by country, U.S., region, South and Latin America. sector, again, so economic sector or type of collateral. So, what is standing behind the bonds. So the construction issues here is that we're going to have, there's a very broad universe, and it's going to require fairly high turnover when we put things together. There is a lack of price data because, bonds eventually find their way into a bond or fixed income portfolio for a life insurance company or a pension fund, and then once the whole issue's nestled safely in the corners of some portfolio, you don't get to observe prices, and that means that we've got this illiquidity problem that we have to deal with as well. Alternative assets, of course, we want to know what's going on in that realm as well. So there's lots of commodity indices out there. So an index of the performance of futures contracts, and you can do it for broad basket of futures types of futures contracts, or you could do it for something that's very focused, and so a wide variety of weights. Real estate, so again, you got several real estate indices out there. So appraisals, that would be like the NCREIF index, meaning that we're using appraisal data. So how did the value of these office buildings change during the quarter? We could do a repeat sales index, which says, hey, over the last 24 months, let's find properties that sold and then sold again. So during this time, and we're going to have to adjust for time and a bunch of other things. It's hard to do. But then we have a market observation and a market observation, as opposed to appraisals, which, appraisals are done from models, and models require people, and people have biases, or at least make mistakes. So appraisal data is something that we're always a little suspicious of. Repeat sales at least has market data, but then you have to ask yourself, well, real estate doesn't trade very frequently. Why did this one building trade twice in 2 years? Is there something different about that building? And then we could also look at real estate investment trusts, which are just companies that own and in a passive sense own and manage real estate. So they're not in the development business. They don't develop and sell real estate. Okay, they buy it and they hold it and they collect rents over the long run. And we can look at the performance of those companies. So they have equity that's outstanding, traded on exchanges. The problem with that is, of course, that if it's traded on an exchange, then the overall influence of the equity markets is going to be part of the influence on the value of the REIT. And so you won't capture fully the impact of the underlying real assets. So hedge fund indices. So we'd really like to know what was going on in hedge funds, but unfortunately we suffer from selection bias and survivorship bias when we try to measure their returns. So they don't have to report. So those people that do report, are they different than the ones that aren't reporting? That would be selection bias. Also, if you took the top 100 or largest 100 hedge funds in the world today and said, let's get a 15-year history and to try to gauge what the returns were on average for those big hedge funds, then what about long-term capital, right? So if you had a minus 100% return, okay, yeah, that is the fund crashed and burned and you're gone. Well, then what we're looking at, if we get the largest 100 hedge funds that exist today, is we're looking at the winners, right? So if you only look at the teams that have winning seasons, then you're going to get a different view than if you had looked at all the teams in the league. So anyway, survivorship bias and then selection bias are going to mess up our hedge fund indices. Okay, and the last few slides here are devoted a few slides on these tables of the different indices that are out there. So there's lots of indexes. So, there's things like the Dow Jones you've probably heard of. Okay, it's, measuring large U.S. based stocks. There's 30 of them in here. It's price weighted like we said earlier. And the stocks are chosen by the Wall Street Journal editors. So that would be, one of the world's most widely cited indices. Okay, we also have the Nikkei stock average, Nikkei stock average, which is large Japanese stocks, 225. It uses a modified price, which means it adjusts for really high price shares. So there's some sort of mechanism there to deal with that. The Topix, this is all the stocks on the Tokyo Stock Exchange first section. So I have a first and a second that I know of. What that says is that anyone that's listed there is going to be a component. So it's going to be variable as firms list or delist out of that first section. So market capital, it's going to be market capitalization adjusted for a float. So if there's founder shares, those types of things. Well, this contains 93% of the Japanese market capitalization. So this is going to have a lot of very small stocks and some liquidity problems and those types of things. So that's going to be 3 different equity indices. indices. And I'm not going to go over all of these just because I don't think that memorizing this is a very effective way to study. But you can look at these for international indices. So the MSCI All Country World Index, 23 developed countries, 22 emerging countries. The constituent securities are going to be variable depending on what's happening with the way they measure inside each country. It's market capitalization weighted, going to be adjusted for float. And this one happens to be available both in US dollars and in local currency. And then you can see that we can look at, an energy sector worldwide. This one is ex-US, meaning that it's going to be energy companies outside the US. So Barclays Capital Global Aggregate Bond Index. So this one used to be a Lehman. Lehman obviously is not managing anymore since there is no more Lehman. So, but this is one that looks at global investment grade bonds, and it's going to be a market capitalization weighted portfolio. You can see that as we go through here is the the NAREIT index that I had mentioned earlier. Here is a hedge fund index. It's the global hedge fund index. Notice that this is asset weighted. Okay, and the next one at the top of the next page, okay, is the same, looks very much the same, right? So it actually has exactly the same constituents, but it's going to be an equally weighted. So you can actually gauge and look at the difference between asset weighted and equally weighted by looking at those two. One of the more interesting might be this Morningstar style indices, and this is where they're going to do a 3x3 matrix. So that's going to be based on value growth, so value, high value, medium, high growth, and then it's also going to be on size, small cap, medium cap, large cap. So 3, 3, that gives you 9 different little boxes. So they've got 9 indices that they are following there. So you can say, well, am I a small cap investor in growth stocks or a small cap investor in small stocks, or am I neutral with respect to small cap and neutral with respect to value and growth? So you can find exactly what you're looking for. Well, not exactly. You can find something that might represent what you are trying to capture in your portfolio that would give you some idea of what your relative performance is. All right? Okay, so a fair amount of detail here. I think the information on the construction of the indices is really important. So you want to make sure that you know how to calculate price and market cap and equal weighted. You want to understand what we mean by float, all those types of things. And I think understanding the decisions that you have to make, that sort of stuff is going to be something you would want to take away from this reading. In terms of memorizing these last 3 slides, I think the table is pretty long. So if you get everything else in the curriculum down, then you can come back and look at this. But I would know the famous ones and I'd understand the issues. But in terms of memorizing the names, I probably would shy away from that as I was preparing for the exam. Good luck with this.